The architecture of modern corporate finance often reveals a precarious beauty, a delicate balance between a triumphant core product and the existential need for diversification, a theme starkly illuminated by the financial ecosystem of Apple Incorporated. While the company projects an image of unparalleled innovation and market dominion, a forensic examination of its income statements unveils a profound vulnerability rooted in its heavy reliance on iPhone revenue. This dependency is not merely a footnote in its annual report, it is the central pillar upon which its entire financial empire is constructed, a concentration of risk that creates a volatile foundation susceptible to the slightest tremors in consumer demand or technological disruption. The iPhone is, in essence, a magnificent cash engine, a product that has mastered the art of generating staggering profit margins and recurring revenue through an ecosystem lock-in. Yet this very success has cultivated a monoculture of earnings. The fundamental financial principle of not placing all one's eggs in a single basket is being tested on a scale never before seen in corporate history, as the performance of this single product line dictates the company's market valuation, its research and development budget, and its capacity for shareholder returns through massive stock buybacks and dividends. The cyclical nature of smartphone upgrades introduces an inherent volatility to Apple's revenue stream, creating a boom and bust cycle tied to product launch years that sends ripples through its stock price and challenges its narrative as a stable, growth-oriented blue chip. This over-reliance creates a strategic inertia, where any significant innovation that could potentially cannibalize iPhone sales is approached with extreme caution, thereby stifling the very disruptive spirit that once defined the company. The services division, often touted as the future, is itself a satellite orbiting the iPhone sun. Its growth in subscriptions, licensing, and warranties is intrinsically linked to the size of the installed base of iPhone users. Should iPhone sales falter, the growth trajectory of this supposedly diversified revenue stream would inevitably decelerate, revealing its lack of true independence. Furthermore, this revenue concentration exposes Apple to immense operational and geopolitical risks, where a single supply chain disruption, a regulatory crackdown in a key market like China, or a paradigm shift in consumer preference away from smartphones could trigger a financial crisis within the company. The capital allocation strategy, while masterful in its execution of returning hundreds of billions to shareholders, is fundamentally a function of the cash flow generated by the iPhone, meaning a sustained downturn would force a painful re-evaluation of these commitments, potentially shattering investor confidence. In the grand theater of global finance, Apple presents a paradox of immense strength derived from a singular source, a testament to product genius that simultaneously embodies a classic portfolio management failure. The company's future financial stability hinges on its ability to successfully cultivate a new, equally profitable revenue pillar that can stand independently of the iPhone. A challenge that requires not just incremental innovation but a fundamental re-imagining of its core business model before the market forces it to do so under duress.